I'm Ashton Addison from EventChain for Investment Pitch Media and FinTech News Network. And today on Blockchain Interviews, we have Daniel Lacalle, the Chief Economist at Tressis. Daniel, welcome to the show, and thanks for taking the time to be here today.
Thank you very much for having me. A pleasure.
I'm really excited to dive into all of the recent topics that you've been focusing on. But if we could kick off the interview with just a brief background on yourself in economics and your recent focuses right now.
Well, my name is Daniel Lacalle. I have a PhD in economics. I basically started my career in the energy industry as an economist and as a trader. I moved on to the sell side in investment banking. Then I continued my career as a portfolio manager at Citadel first, then at Ecofin, and finally at PIMCO, and have been conducting basically macroeconomic research and very market-driven since.
Mm-hmm. Very, very nice. And I want to touch on some of the energy questions as we dive into the interview here as well. So I'm glad that you have a background in that. But first question I want to ask is about the most recent current events. The presidential election last week, and now the news on Monday here with Pfizer coming out with a vaccine that has 90% effectiveness, and the reaction in the stock market and the equities really, there was a gap out to new all-time highs in the market, and everything seemed really optimistic. But I want to get your take on this, because it seems like the market may be too optimistic, and maybe this is also a sell the news moment where it's actually, a lot of the higher value investors are actually, taking profits at this time when there is all this optimism. So what do you take of this moment where the president-elect is announced the day after the moment the stock market closes, and when it happens to open the first business day, this optimistic news comes in? It seems very timely.
It is surprisingly timely, isn't it? And one would even start a conspiracy theory about why this timing has been so perfect. But usually, when timing is so perfect, it tends to be more. It's not a causation, but it is basically a coincidence. Let's start with optimism. I think that markets in general are starting to sometimes price 2 and 3 times the same event. Remember that when everybody was talking about the V-shaped recovery, and when people have been buying into the market based on the idea that the worst was over with the reopening of the economies in the second quarter, the vast majority of brokers, analysts, investors, etc., were already discounting that there would be a vaccine at some point in 2021, or a number of vaccines, and all of the estimates already discounted that the end of the pandemic would be in the first quarter of 2021. Therefore, it sounds almost counterintuitive that the market goes out and discounts yet again the same event. And in numerous cases, what this provides is a fantastic opportunity to reduce exposure to the more cyclical sectors, because the underlying challenges of the economy remain. We have been putting everything under the umbrella of COVID-19, and the challenges of low productivity growth, of poor earnings growth, of low margins, the challenges of high debt and weak job creation, all of those in the developed economies remain. No? So I think that when you see an event like Monday, in which brokers are, remember that brokers started the month by saying there's going to be a blue wave, and the blue wave is an opportunity to buy the market. Then there was no blue wave, and brokers tell you that it's an opportunity to buy the market as well. Then we have a contested election, and it's also an opportunity to buy the market. And the vaccine, we have been seeing new all-time highs on every piece of news flow coming from the Oxford or the AstraZeneca or the Pfizer vaccine. So when everything is driven by ETF, and you see that the volumes are huge, and those volumes are driven fundamentally to drive the the stocks that are most exposed to an ETF or that have higher weights in an index. Therefore, it is a good opportunity to look at short opportunities in the more cyclical and the more challenged sectors.
Yeah, it's a really interesting opinion, Daniel, because right now, with all the optimism, as you said, there's a V-shaped recovery, and a lot of retail investors are starting to become interested in the stock market and equities when they weren't before, and there's new players coming in. But that's not really the smart money that has been watching the market for years and decades. But with the potential Biden presidency having more spending and more deficit to help regrow the economy, that seems like it's a green light for Wall Street to continue and having, the trend is your friend, and right now it's going up, so it does continue to go up. And there are a lot of contrarian economics that are saying, eventually there's going to be a retracement or a crash or something like that. But a lot of people have been saying that for a long time, and right now it continues to go up. So I'm curious on your take on, in the next few months, as we're continuing this upward trend, does Wall Street just continue, to at least the end of 2020 in the next 2 months here, where we just continue to go to new all-time highs?
Yeah, I think that it's a very interesting dynamic that we're seeing in the market. And there's an ongoing message, a consensus message, that markets are at all-time high. Yet, if you look at, for example, the European markets, they have done absolutely nothing since 2016, 2018. You look at emerging markets, they've done virtually nothing. And if you look at the S&P 500, about 60% of companies that are within the S&P 500 are not even up in 2020. So I think that it's an interesting dynamic because on one side there are signs that there is this reality is actually, and fundamentals are actually working. Is that if you look, for example, at why growth versus value continues to outperform, why the so-called value stocks that tend to be value traps, continue to underperform. And we see that it's a very elite, very small club of stocks that actually are doing really well in this environment, then you actually realize that fundamentals are actually working. That it's not just central banks pumping the market. Yes, the S&P 500 is at all-time highs, the Dow is at all-time highs, the Nasdaq is at all-time highs, and that's basically it. You look at markets globally, and they're not doing well. Investors are not making money because they lost money in 2018. 2019 was a good year. 2020 has been an atrocious year. You have numerous funds out there that have not generated any positive performance in 3 to 4 years. So I think that it's a good moment to step back, forget the so-called "don't fight the Fed" rhetoric, which is false, and think, okay, what have we learned from these years of financial repression? We have learned that growth massively outperforms value for a reason. We have learned that technology is not as expensive as we thought a few years ago. We have learned that the cyclical industrials and the stocks that are more exposed to the economic cycle don't perform adequately. And we've learned that these types of bounces that are aggressive in form end up generating opportunities to underweight these, let's say, old economy type of stocks. So I think that we will continue to see all-time highs in some indices for a very simple reason. The reality is the debasement of money. So as long as central banks are going to continue to pump liquidity in the market and lowering rates, and we get into the nightmare of negative rates and more and a bigger liquidity trap, we will continue to see, for example, in the markets in which equities are not performing, we will see that, as we have seen, that bonds are actually performing very well, because that's where the newly created money is going, is to bonds. no? But we have to therefore be a little bit more detailed, a little bit more granular about our investments, and not think that central banks cover any investment mistake. Because if you're, for example, an investor in the European stock market, you're basically losing money for a good number of years, except in the DAX. So I think it's an important. It's important to go and to look at the details, and that helps investors make wiser decisions than simply believe that central banks are going to solve everything.
Definitely. Now I want to dive into the energy question, and part of the campaign when the election was nearing its end was Biden talking about potentially banning fracking or moving to renewable energy sources. And Trump was talking about how that would obviously have a huge impact on the oil industry. And, the oil industry is really, the lifeblood of the industrial complex as well. And if that does go through and Biden starts to focus on renewable energies and take away from the oil industry, how do you see the markets shifting, in the next 8 months in America?
Let's talk about the hidden stimulus that Joe Biden as a vice president lived, which was the fracking revolution. The Obama administration in its 8-year tenure lived an absolutely massive stimulus coming from the development of the oil and gas industry that generated millions of jobs and at the same time made energy prices cheaper for consumers, which was a much more effective stimulus than the massive spending and the liquidity injections of the Fed. Although obviously the energy revolution came precisely as well, helped by low interest rates and high liquidity. But what we have seen is that you should not decide between one and the other. Is that you need to look at energy transition from a competitive perspective. The United States is the only big economic agent that has been able to reduce emissions at the same time as become a global leader in renewables, the biggest country in renewable investment in the world, with a thriving oil and gas industry, and become energy independent while bills for consumers have been coming down. It's the only country in the developed world in which the development of renewables has not doubled or massively increased the bills for consumers. Why? Because it was the combination of renewables and natural gas that was an absolutely winner combination that helped bills come down, competitiveness improve, the competition of renewables and natural gas helped shape as well a much stronger environment for companies, and consumers didn't suffer. If Joe Biden decides to undertake the same policies that Germany or the European Union has followed, what he's going to find is that it's going to become a detriment to job creation, to growth, and to the disposable income of consumers. In Germany, the average household bill of electricity and gas has doubled in the last 10 years. In most of the European countries, they pay between 1.5 to 2 times a higher price for electricity and gas than what a household pays in the United States. So any intelligent person, and I don't doubt that Mr. Biden is an intelligent person, will continue to see that what the United States needs to do is to continue to develop the renewable sector as it is very, very strongly. With the Trump administration that was supposed to be allegedly anti-renewables, the United States became the top investment for renewables globally. And at the same time, keep the benefits of a thriving natural gas industry. Think about this. North Dakota has one of the lowest unemployment rates in the world, not in the United States, in the world. If you in North Dakota decide to ban the oil and gas industry, you're going to do two things. First, it is impossible to offset the loss of jobs in the energy industry, in the oil and gas industry, with renewable jobs. We all know that you'd need between less than half, in some cases 60% less people working in a solar panel structure or in a windmill structure than in an oil and gas facility. Everybody knows that. So it's impossible to offset it. So what you need to do, and what they need to understand, is what they understood, what Obama and Biden understood when they were in power, is that you cannot just simply go out and, for ideological reasons, destroy an industry that is going to continue to create millions of jobs while you continue to support, which is fine, a renewable sector that is thriving, because it's not a question of government support. It's a question of technology.
I really like that point, and how you also threw it back to the costs for households and their energy costs go, 1.5 to 2x. Obviously, that's going to have a huge impact on the States as well. And I think that having that transition and the competitiveness and allowing the private sector to, grow at a rate that it's does naturally rather than through legislation is obviously the right way to go. So we are running out of time, but I want to ask you one last question about hedged assets in the market. The stock market's done really well this year, but what's done almost the best returning asset this year is Bitcoin. And there's been a lot of institutional interest. There's been Visa and MasterCard and chartered banks and major institutions coming up and being large proponents of Bitcoin. I want to hear your thoughts on, do you see Bitcoin as a store of value, or at least a diversification into a well-balanced portfolio?
I think that Bitcoin is becoming a real decorrelated asset that helps in a portfolio relative to the proportion of stocks, bonds, real estate that you might own. Remember that stocks and bonds, unfortunately, are hugely correlated because of central bank action. So to have an asset, Bitcoin, like gold, that works because it's decorrelated from traditional assets, and at the same time because it works as at least as a startup of a store of value relative to fiat currencies, that actually is something that becomes very attractive. And that is why what we're seeing is that now that the phase of doubt has ended and that people know that Bitcoin is here to stay, a lot of institutional investors are looking at it from the perspective of something that you have in your portfolio, maybe with a small allocation, whatever, but that generates a diversification from the performance of extremely correlated assets. And I think that that is an important factor. One, decorrelation. Second is store of value, or at least an alternative to the debasement of fiat currency.
Great, Daniel, and we're out of time. I really appreciate you bringing all these insights into all the current events, because there's so much going on right now. Where is the best place for people to follow your work and learn more about what you're continuing to post about?
I'm not difficult to find. You can find me on my website. It's www.dlacalle.com. You also can find me on Twitter at DLACALLE_IA, and you can find me on LinkedIn or on my YouTube channel. You type in Daniel Lacalle and you can find all my videos where I talk about all of these things in actually 2 languages. So hopefully we can find each other and continue the dialogue.
Great. Thank you so much, Daniel, for the time. All the best moving forward, and let's follow up in the near future.
Absolutely. Thank you so much for having me, and have a great day. Stay safe.